A very good morning, one and all the students. I warmly welcome all of you for the 12th live webinar that is happening on a weekly basis every Sunday from 10 to 12:30. And the response from the students have been so amazing. On an average, around 8 to 10,000 students across the country are attending. I really appreciate the students. Know that you people are packed with your articles, studies and all. In spite of that, your enthusiasm to update yourself, which is the entire objective of the profession, that members and students should have that consistent updation of technical knowledge, you being a part of it, and I really appreciate for that. Let me tell you, in our profession, it is always about the consistent update of the knowledge that makes you on par, and I'm sure that our members and students are trained in that regard. Today, we have our council colleague and the senior most member and a more knowledgeable, and let me tell you, he is the chairman for the International Taxes Committee. So I feel the students are lucky enough to have him. Sir, welcome to the session. On behalf of BOS, we really want to thank you for taking out your precious time on Sunday and being a part of
Not at all, sir. It is a direction. He should, whenever says I am there.
That's so nice of you, sir. And with us, we have the two eminent faculties today, Mr. Shivateja, who is from Hyderabad, and who has worked in a Big Four and who has presented so many papers on direct and indirect taxes. He is being training the student from long time, and he's also into a practice from 11 years. So I'm sure his experience and expertise will add a value to the student. Good morning and welcome, Shivateja, for the session.
Thank you very much.
We have another speaker today. Yeah, Mr. C.A. Rishikesh. So I need not tell, his name and title itself indicate Chairman Vikasa. So that shows how passionate and connected he is with the student. So he is being an active participant and has really mentored many of the sessions of the student, both at national and international level. So good morning, Mr. Rishikesh. Thanks for taking out your time for the students. So dear students, and how well we are versed with the current situation. As we know that technology has roped in deeply into all the profession, now that we can't stay away or be away from the part of the technology. So council has decided that we need to train our students and make sure that every student is versed with the technology. Though we have a part of an ITT orientation kind of a thing, but we want subject related technology to be roped in. Today, if you take up your direct taxes, indirect taxes, MCA, all of us are talking on the web portal. So we thought every student should have a training on the part of it, along with the subject, how we manage the technology and web portals while filing. And I'm sure this knowledge or insight will really help you while applying your articleship. And especially coming to today, capital gains, more interesting because the topic itself has a gains. And a lot of you students also might be facing questions from your near and dear friends, relatives and all, because we sold this asset capital gain aayega ya nahi aayega. Because this is a topic which is connected. So when it comes to salaries or business or profession, it is for a specified category. But at the capital gain, I know all of you would be facing the questions from the people. And sure, this will help you with all the practical situation. And I wish that both the speakers will train our students and also answer their FAQs. So first, I would like to request Sanjay Bhai to have his word and really enlighten our students. After that, we'll go ahead with our faculty. And in this part, let me appreciate all the team members who have taken out the time. I always really feel sorry whenever a Sunday comes, the team who gets only one day, but still when it comes to the student, BOS always stands first. They took out their time and being a part of this, and they are throughout with you. So I really appreciate Kapil, Alok, Vidhi, and all the Board of Studies team. And I'm really hats off for the time you have taken out for the students. Thank you very much for that. Sanjay Bhai, over to you.
The mic. Unmute.
Sir, you are on mute, sir. Sir, you are on mute.
Thank you, Sridhar. And I'm rather feeling proud that in the student, I'm there and involved there, and the numbers which you are talking, it's quite fascinating that we have 8,000 members in the this particular topic. I want to add on the efforts of the institute and especially the Board of Studies. We reading in the newspaper that one of the ranker have said in the press that he has never gone to any tuition. He has just studied and attended the material of the institute on the its portal and has attended the classes. So I want to give a message to the all the students that look, it is not that we should go always to any place. It is the institute level we are also doing, and we are trying to give you the best of material which is available. And the best part of that is this, that when you learn from the portal of the institute, then you have lot of updates which you will not get when you will go to the faculty in learning the classroom or the online also. Now, coming to the topic, capital gain. Only few of the things which I would like to add from my experience is this, that in last 36 years, whenever capital gain query comes, at that time, I do only one thing is this, to take out the book in front of me and read once again, anytime if I wanted to reply. Because the capital gain is so much, you can say, widespread, whether it will be a short term, whether it will be a long term, whether it will be a business, if it is a derivative, whether the presumptive taxation will be there, or whether the indexation will be given, the costing, how is to be calculated, and so many steps which are involved in this, whether it can be offsetted with the other income or not. So the capital gain is a part in the Income Tax Act, which is very specific and very specialized one. Just even for the sake of even, if you are learning from the point of view of the exam, but at the same time, as my co-brother in the council has said, that look, everyone asks you a question, because in your family, in your friends, in your clients, everywhere they will ask you a question and you need to answer it. So the chapter on the capital gain is very apt topic, is being chosen by the Board of Studies in the practical module. So please do not think that the faculty which is going to Tejas and Rishi Bhai, it will be used in your only exam, but it will be used in your practical career. And you see, when somebody asks a question from me or from any student or from anyone, then if we give a correct answer, we feel pride, because somebody who's taking the decision on the basis of your advice is very important. And any one step, if you give it wrong reply or you are not updated, then you are out. Like, for example, only yesterday I was traveling to Rohtak, there was a call came. The member asked me that, look, my father has sold a property and he wants that the capital gain is to be invested in my hand, and he is going to give a property to me. So I need to see this. Some of the court cases says, yes, it is possible. But of late, some of the cases where we have held that no, it is not possible. It has to be invested by the person in whose name the gain is coming. So with this little bit background, I'm once again thankful to the Board of Studies, the entire team. And as Sridhar has said, working in a government atmosphere and looking that Saturday, Sunday will be off, it is not the council member, those who are working 24/7, but the team at Board of Studies, they are working. And I can tell you that they followed me when they fixed up the lecture. Then they gave me some of the material to go into as to what they are doing. Then yesterday also they called me. Today I logged in from not my name iPad, because the moment I enter into the system, only my name appears. Then they said, "Sir, are you facing any difficulty in logging?" So you see, the deliberation will be only for 2 hours or so, but the effort put in behind that by everyone, by the team, Alok, by Kapil, very old associates, all they are seeing us in the council for last 20 years, 15 years or so. And Vidhi being one of the, you can say, holding the charge for the in charge as all of this. So they are in the front, but those who are on the back, those who are developing, but never feel shy in providing your feedback. And as my brother has said, the question answer, though they are on silent mode or somewhere, but in the chat box or somewhere, the question will come. So I will request the faculty that at least 10 to 15 minutes of your deliberation for the question answer, whatever you get, even if you are not getting from the student, but you should tell them beside the law, the practical question which come, because today in the practical life, in the exam also, as in the shoot in the new curriculum, we are going to change from the book to the practical. So with this, once again, thank you very much. And I'll try to remain for some time. And then if I feel, I will come back again. Thank you very much once again for the Board of Studies to give me this opportunity. Thanks a lot.
Thank you, Sanjay Bhai. And thanks for taking out your time and for the valuable words what you gave to the students. So now I request the faculty and Shivateja to.
Thank you, sir. Thank you, Sridhar Mupala, sir. And thank you, Sanjay, sir, for your insights in terms of one of the finest and interesting topic known as capital gains. As you rightly said, that this is one such question which commonly keeps coming to every one of us in every walk of our life, because it's very common there. See, there was a time when we used to say that ITR 1 is very simple because it's salaried employee, and ITR 4 and 3 take some effort because there is a business income. But today's day, whenever a salary return comes to me, I need to actually spend a lot more time than a business return, because that salaried employee has got capital gain from shares, capital gain from mutual fund, capital gain on securities, what not. There is a multiple activity of capital gain which is being involved. And students get often confused in terms of how do we give a treatment for security? How do we give a treatment for the share? How do we give treatment for land and building? And let me say you, for every different type of asset, there is a different treatment for capital gain given in the law. One of the most complex and interesting topic of capital gains. And I still remember the words of discussion, what I always have with Sridhar sir, which he keeps saying that if you don't update, you will outdate. That's pretty simple. So it is very important for us to update with the latest provisions, and I'll put my best effort to ensure that we will discuss all the interesting elements from the subject point of view, along with reporting in the income tax return. And what can be the best time then other than this, where just at the edge of filing of our returns, we are discussing this brilliant topic. And I'm sure after this session, you will definitely get some more better idea in terms of how do we report this capital gains in ITR. I'll do that. End of the session, I'll give some sweet time so that we can discuss all the question and answers. Thank you. So I'll share my screen and share the presentation so that it'll be easy for us to understand the things more effectively. Kapilji, is the screen?
Yes, it is visible.
Yes, sir. Yes, sir.
Yeah. Thank you so much, sir. Thank you. So let's talk about this beautiful topic known as capital gains. See, when we talk about this word capital gains, what are we trying to understand? We are basically trying to understand the gain what we get from sale of a capital asset. And we know that we have got two types of capital gain, such as long-term capital gain, short-term capital gain. And it is very important to classify them perfectly, because the tax rate in long term and the tax rate in short term is way too different. So that classification is of utmost importance first. Let's see that first, then we'll move forward. So guys, what are we going to talk in this session? First, we are going to talk about the chargeability section. Then we'll talk about the types of capital gain. Then we'll talk about the rates. Of course, then we'll talk about one of the most brilliant, interesting topic, that is about exemptions under capital gain. And post that, we'll talk about how to report this income tax return. That also we'll talk. From the ITR, we'll specifically open the capital gain schedule and specifically understand in terms of which figure is to be reported in which column. So ITR reporting is not just about punching some numbers and filing the ITR. See, there is a small wrong apprehension what people carry, that filing ITR, job is over. But let me tell you, once you file the ITR, the job will actually begin, because tomorrow when any question is being asked on the information what you have fed in the income tax return, you should be able to substantiate that data. That is very important. That is very, very important. So guys, see now, what is the chargeability section income tax with regard to capital gains? That's given by section 45, subsection 1, which talks about capital gains shall be. There should be a capital asset. That's very important, that there should be a capital asset. Now imagine Shivatej has got a bike with me. Now, is my bike an asset for me? Definitely answer is yes. My bike or my car is an asset for me, which I have shown in my books of accounts, on which I'll definitely charge depreciation. But let me honestly tell you, that is an asset for accounting standpoint, but that is not a capital asset under income tax standpoint, because under income tax standpoint, capital asset definition is very different. So we need to understand what is a capital asset. In other words, asset should be capital asset and on the date of transfer. So what asset you have transferred should be a capital asset, and it must be transferred during the previous year. So point number 1, very clearly they told in the law that you must have a capital asset, and that capital asset should have been transferred during the previous year. And there is a profits or gains as a result of such transfer. There is also a possibility that you might end up getting capital loss also, because your selling price is less than your cost price. That is also possible. And there is specific provision in the law which talks about how do we set off this capital losses with capital gain. That also I'll touch upon during our discussion. Now, next. So in simple terms, this is what is the whole conditions, what you have to keep in mind, that there should be a capital asset. It must be transferred. There is a gain in the previous year, and the gain is not exempt. If the gain is exempt, there is no question of paying capital gains tax. Obviously, right? Of course. Now, what is a capital asset? So let me tell you in simple terms, what is a capital asset? Capital asset is nothing but a property of any kind, which could be movable, or it could be immovable, or it could be tangible, or it could be intangible. So guys, what did I just say? That capital asset can be a movable, immovable, tangible, or intangible. Anything can be covered under the definition of a capital asset. But some interesting point to be noted is that capital asset excludes some things. What is excluded? Number 1, stock in trade. Of course, it is a basic fundamental common sense that stock in trade is excluded, because when you sell a stock, you will show it under business income, that is under PGBP, but not under capital gain. Second, this is what I was talking about when Shivateja gave an example of bike or a car. That is movable property held for personal use. Technically, we call it as personal effect. Personal effect is any movable asset which is held exclusively for personal purpose. Example are clothes, a bike or car or a laptop or a spectacles. These all will come under personal effects. So when we sell them, there is no question of capital gains tax, because they are not covered under the definition of capital asset. Next one, rural agricultural land in India. This point is very, very important, especially considering the fact that since last 5 to 10 years, we all know the amount of demand which lands have created in India. Every kind of person, whether he is belonging to a segment of upper middle class or higher class or lower class, the logic became very simple that whatever money he is making, he is trying to consolidate that money and trying to put in an land. Could be an open plot of land, could be an apartment, or could be an independent house, or could be an agricultural land also for that matter. So the demand for land and building has drastically increased, especially since last 10 to 12 years. And there has been considerable number of transactions where people have been buying the properties and they have also been selling the properties. So when they are buying and selling, the difference ends up becoming a capital gain. And a lot of times, a lot of my clients keep coming to me and saying, sir, I sold a property, I purchased and I sold same property. I keep telling them, boss, get ready, pay capital gains tax. He will just tell me one simple word, sir, I made some profit, that is my talent. Why should I pay to income tax? Let me honestly tell you, income tax is as good as our life partner. The way our life partner is going to stay with us, in the same way, income tax will stay with us forever. Income tax is going to stay with us forever, where any income we earn, we are required to pay income tax. There is no question of saying why we have to pay. Constitution has given power to the government to levy that income tax. Entry number 82 has clearly given that power. So there is no way we can say, why should I pay income tax? Then, specified bonds, something like special gold bonds or national defense bonds, they are also not covered in the definition of capital asset. But other than that, any kind of capital asset, which could be movable or immovable, tangible or intangible, that is covered in definition of capital assets. And here, moving the other side, capital asset also include, friends, what is that line here? Capital asset also include, left side you see, very, very interesting line. Any rights in or in relation to an Indian company, including rights of management or control or any other rights whatsoever. So basically, we are not holding shares directly, but we are having rights in an Indian company. In fact, this is one such amendment which has specifically come up in the law post Vodafone case, which I'm sure most of you would have heard that Vodafone case. In simple nutshell, for those who have not heard that Vodafone case, simple way, let me tell you, my dear friends, there is a foreign company which is holding shares in another foreign company. And this foreign company is holding shares in an Indian company. Correct, my dear friends? And what has happened in that case is that one foreign company, I repeat again, one foreign company transferred shares in another foreign company to another foreign company. Come on, let me repeat again. One foreign company transferred shares in a foreign company to another foreign company. Directly, Indian company is nowhere involved. But one foreign company transferred shares in another foreign company to another foreign company. But by virtue of this transaction, rights in an Indian company were getting transferred. In other words, there was an indirect transfer of an Indian asset. And they have specified that this is an indirect transfer of rights in an Indian company. So they made an amendment in the law specifying that rights also is covered in the definition of capital assets. So capital asset could be movable or immovable, tangible or intangible. But capital asset does not include stock in trade. It does not include rural agricultural land, which we'll talk in detail. It does not include personal effects, or it does not include any special bonds, which are notified by the government. Other side, securities held by foreign institutional investor. If there is any FII sitting outside India, who is a foreign institutional investor, he is purchasing securities in India. That security is what he purchased in India shall also be regarded as a capital asset. Next point. Any ULIP. Friends, what is this word? ULIP. ULIP stands for United Linked Insurance Plan. What is this word? United Linked Insurance Plan. See, basically, when we talk about ULIP, it's very common that a lot of people take an insurance. Could be life insurance, could be medical insurance. Of course, some of them take life insurance only to claim benefit. And some of them take medical insurance only to take 80D benefit. And some of them take life insurance, take medical insurance, and along with that, they also enjoy 80C and 80D benefits. Correct ones? Exactly. So now, when I talk about this ULIP insurance plan, United Linked Insurance Plan, which we're talking about, this United, that is Unit Linked Insurance Plan, basically, this ULIP is a kind of a scheme where whatever premium we are paying, this premium is towards insurance, but there is also an element of investment, what that entity makes on our behalf. And we all know the concept of this word called mutual fund. When I talk about this word, we know very clearly that mutual fund is a kind of a collective investment scheme where what happens in mutual fund, we all invest money in mutual fund. Mutual fund is not doing business with that money. They are only investing somewhere on our behalf. So they don't give us a share, they give us a unit. Since they're investing somewhere on our behalf, if they get a profit, they give us profit. If they get a loss, they give us loss. That is the reason why we say mutual fund is subject to market risk. This ULIP, what we are talking about, whatever premium we pay is partly towards insurance and a part of it goes towards investment on our behalf. And once upon a time, there was no limit on this ULIP, unit-linked insurance plan. Whatever maturity premium we get, it used to be exempt. But now, a fantastic amendment has come up in 2021, where with effect from 1st of February 2021, this ULIP became taxable. If the yearly premium what we are paying is more than 250,000, then definitely this becomes taxable. One of the very interesting amendment and a very practical point, unit linked insurance plan, which stands for ULIP. Next point. This point already I discussed with you what are covered in personal effects, but personal effect excludes some points. What is that? Jewelry, archaeological collections, drawings, paintings, sculptures, any work of art, or any mobile property. So these, if they are sold, then definitely capital gain will come into picture. There is no question of any exemption as such, unless we are satisfying specific conditions of 54F or B and all. Clear, my dear friends? Now, one point let me tell you. It is very common that a lot of people sell jewelry items. These archaeological collections, drawing, paintings, sculptures could be a rare scenario, but jewelry is something very common. So if jewelry is being sold, let me tell you, jewelry is not a personal effect. Sometime back I told you that bike and car can be regarded as personal effect, but jewelry cannot be regarded as personal effect, since in definition only they specifically told that personal effect excludes jewelry. So when a sale of jewelry, capital gains will attract based on type of capital gain, long term or short term. It depends. Then agricultural land, as I was talking about the story of rural agricultural land. Friends, whenever a person sells rural agricultural land, there is no tax. But if the person sells urban agricultural land, definitely is required to pay tax. Now, when I talk about urban agricultural land, rural agricultural land, what is the definition given in the law? Now, simple terms, let me explain you, my dear friends. Imagine a land is within the municipal limits and the population is not less than 10,000. Then they specified that this land is known as a urban agricultural land. But however, if land is outside the municipal limits, they gave a criteria of 2 kilometers, 6 kilometers, 8 kilometers, subject to the population condition. See now, agricultural land does not include land situated within the jurisdiction of municipality and notified area or committee, town area committee, cantonment board, and which has population of not less than 10,000. Then it becomes an urban agricultural land. If it is urban agricultural land, sale of urban agricultural land will attract capital gains tax. But sale of rural agricultural land, there is no capital gains tax at all. So it is very important to understand whether a land is an urban agricultural land or a land is a rural agricultural land. So if land is within the municipality, come on guys, what is the line I just told? If the land is within the municipality and population is not less than 10,000, then it becomes an urban agricultural land. Land is within the range of following distance measured aerially. This is important that we should see shortest aerial distance. We should not see distance through road. We should see distance through aerial. You might get to find out, sir, how do we see the aerial distance? In fact, when I dealt with this case a couple of years back, one of our clients sold urban agricultural land. Discussion started coming whether it is urban or rural. In fact, in Google facility, latitude, we can figure out what is the aerial distance. That's very much possible because law is not talking about road distance. Law is talking about aerial distance. Within the range of following distance measured aerially from local limits of any municipality or cantonment board, not being more than 2 kilometers. If population is more than 10,000, that means if the land is within 2 kilometers and that too population is more than 10,000, it becomes a urban agricultural land. Second possibility, land is within 6 kilometers and population is more than 1 lakh, then also it becomes an urban agricultural land. And last possibility, land is within 8 kilometers and population is more than 10 lakhs, then also it becomes an urban agricultural land. And if land, urban agricultural land, then the provisions of capital gains will attract. But if the land is a rural agricultural land, that is not taxable at all. So friends, if there is a municipality, if the land is within municipality and population is, what my dear friends, greater or equal to 10,000, then it becomes an urban agricultural land. Or it is within 2 kilometers and population is more than 10,000, then also it becomes an urban agricultural land. Within 6 kilometers and population is more than 1 lakh, then also it becomes an urban agricultural land. If land is within 8 kilometers and population is more than 10 lakhs, then also it becomes an urban agricultural land. So it is very important to understand this definition of the word, what is urban, what is rural. Because if the land is a rural agricultural land, there is no tax at all. But if the land is a urban agricultural land, then the provisions of capital gains tax will apply. And one more interesting point, let me tell you, when I talk about this word, population of 10,000, 1 lakh, 10 lakhs and all, we will see this population as per the latest census. That is very important. And Government of India does population census every 10 years once. 11, which was supposed to be done in 21, which will be done very soon. Next, capital asset, it can be short term and it can be long term. And let me tell you, short term, long term is based on some cases 12 months, some cases 24 months, some cases 36 months. And it is important to understand which case it is short term, which case it is long term, because the tax rate for long term and the tax rate for long term both are different. I repeat again, tax rate for short term and the tax rate for long term both are different. So it is very important to understand what is the tax rate in different circumstances and how do we classify this long term and short term, since the tax rate is very much different. I am sure we are getting clarity on this point, everybody. So in some cases it is 12 months, some cases it is 24 months, and in some cases it is 36 months. Important for us to understand which case it is 12, for which case it is 36. Now see here. These are all the cases where if it is more than 12 months, it becomes long term. More than 12 months, it becomes long term. Now, what are all covered here? First one, equity or preference share must be listed. This word is very important, listed. Next, securities other than units, debentures and term capital asset. So it is important to understand which case it is long term, it is short term. Correct? Now, for listed securities, what is the time criteria? More than 12 months long term, less than 12 months short term. So for example, if Shivateja is buying shares of Reliance and I hold it for more than 12 months and then I sell it, it becomes a long term. And if then it becomes a short term. Then units of UTI, Unit Trust of India, then units of equity oriented mutual fund. This is interesting. Equity oriented mutual fund. Friends, I just told you what is a mutual fund. Mutual fund is something like a collective investment scheme. See, that is the reason why mutual fund does not give a share, they give a unit. See, for example, Shivateja is investing in Reliance. Reliance will give me a share because whatever money I invested, doing business with that money. But when I talk about a mutual fund, if I invest money with mutual fund will not do business with that money, but instead mutual fund invests that money outside. And from that outside, mutual fund gets profit, they'll give me profit. If they get a loss, they'll give me loss. And that is the only reason why we say mutual fund is subject to market risk. Now, what is an equity-oriented mutual fund? In order to regard a mutual fund as equity-oriented mutual fund, there could be two possibilities. Possibility number one, a mutual fund which invests at least 65% in equity shares of domestic company, then that mutual fund is regarded as a equity-oriented mutual fund. So our first possibility is what? 65% it is investing in equity shares of domestic company. Second possibility, if the mutual fund is investing in another fund more than 90%, and that another fund is in turn investing 90% in equity shares of domestic company, then also it is regarded as equity-oriented mutual fund. Fund is directly investing 65% in equity shares of domestic company. Second possibility, fund is investing 90% in another fund, and that fund is investing 90% in equity shares of domestic company. In both the cases, first case, second case, both the cases, they are regarded as equity-oriented mutual fund. It is very important to understand whether the mutual fund is equity-oriented or debt-oriented, because for equity-oriented mutual fund, period of holding is different, tax rate is different, computation mechanism is different. Then last one bond, also practically called as ZCB. In fact, ZCBs are those which are issued at discount, but they are redeemed at par or face value. That is the reason why they are called as zero coupon bond. They are known as zero coupon. Name only says zero coupon. That means zero interest bond, which are issued at discount and redeemed at clear. So if you observe carefully, technically there are 4 cases which are covered under 12 months. Number 1, listed securities. Number 2, units of UTI. Number 3, units of equity-oriented mutual fund. Number 4, zero coupon bonds. In these 4 cases, if they are held for more than 12 months, they are regarded as long-term. But they are held for less than 12 months, they are regarded as short-term. Moving forward, special assets. There are 2 special assets. Unlisted equity shares. Come on, first one, unlisted equity shares. And second one, immovable property being land or building or both, our favorite topic of discussion. Because I'm sure a lot of times clients keep coming to, sir, हमने ये property बेच दिया, sir, हमने ये property खरीद लिया, sir, we sold this property, sir, we purchased this property. It's very, 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 very common that a client keep coming to us with a sale and purchase document, and we start introspecting what is the sale consideration, what is the stamp duty value, what is the purchase price, what is the difference, what is indexation, all that activity we keep doing. Correct, right? Exactly. So for these 2 assets, my dear friends, if it is held for more than 24 months, we call it as long term. And if it does not exceed 24 months, we call it as short term. Clear? So 12 months, we have got 4 categories. Number 1, listed securities, units of UTI, units of equity-oriented mutual fund. Last one, zero coupon bond. And in 24 months, we have got only 2 types. That is unlisted equity shares. Second one, land and building or both. There is nothing but immovable property. So these 2 cases, if it is held for more than 24 months, long term, does not exceed 24 months, we call it as short term. And the rate of tax, as I told, for long term, short term, both are different. Yes, my dear friends. So in 12 months, how many types of assets are there? 4 types of assets are there. And what about 24 months? 2 types are there. Unlisted equity shares and immovable property being land or building or both. Moving forward. So what about other assets? Something like I sold some debentures or I sold some jewelry. In all other assets case, it is more than 36 months long term, less than or equal to 36 months, we call it as short term. So in nutshell, my dear friends, we have got only 3 categories. Category number 1, where in 4 assets, it is more than 12 months long term, does not exceed 12 months short term. And for these 2 assets, more than 24 months long term, does not exceed 24 months short term. Any other asset, more than 36 months long term, does not exceed 36 months, it becomes short term. Moving forward, transfer of capital asset. As we just discussed, my dear friends, it is very important that first condition, there should be a capital asset. That's what we very clearly discussed. Second condition, such capital asset should have been transferred. This word transfer is a very powerful compared to the word called sale. Sale is a much more simpler word, but this transfer is word which is very complex. Like in your GST, you don't find a word sale purchase. There you find a very interesting word called supply. In the same way, here you don't have a word called sale of capital asset. Here they use the word transfer of capital asset. Now see very clearly. What is covered in transfer of capital assets? See now, transfer covers sale, exchange, or relinquishment of capital asset. Giving up the asset, you are relinquishing your rights on the asset. Relinquishment of the asset. Number two, extinguishment of right. When an asset is given up, we say relinquishment of asset. When a right is given, we say extinguishment of right. Just to give a small example for extinguishment of right. Sir, imagine Shivateja has got some shares in a company. Okay? Let's say there's a company A Limited. In that company A Limited, Shivateja has got some shares. And that company A Limited offered me right shares. Telling that Shivateja, if you want to take right shares, you can take these right shares. Right? Now, when you give me right, there are two options. Number one, I can exercise that right. Number two, I can give up that right to another person. Technically called as renunciation of rights. Renunciation of right means whatever right I had got, I had a right to that right, I can transfer it to another person. So technically it becomes like an extinguishment of right, which is also regarded as transfer. Correct, friends? That this word transfer is a wider word compared to the word sale. So transfer include sale, relinquishment of the asset. Number two, extinguishment of any rights. Number three, compulsory acquisition under any law. Compulsory acquisition is something like takeover of properties. Lot of times, maybe for metro rail extension, or maybe for a development of some infrastructure, or a development of some capitals, government might take over some land for which they give a compensation. And income tax says that compensation also is taxable. No, don't start crying. Sir, why is the compensation also is taxable? See, we are not taxing the entire compensation. That compensation becomes full value of consideration. From that, any day, we reduce the cost and we tax only the difference amount. At any given point of time, we are not going to tax the full value. We are only going to tax the gain. That point should be very clear for all of us. Next point. Conversion of capital asset into stock in trade. This point I have just seen few days back only in one of our client case. What has happened is, there was one person, Mr. X. He had got a plot of land, which was close to about 2 acres of land, which was his personal asset. And what the gentleman decided is, on this 2 acres of land, he decided to convert that land into plots and sell the plots. Sell the plots. So he decided he will start doing the business activity of development. So basically what he has done, my dear friends, he has got one capital asset, and that capital asset he converted into a stock in trade. And law says that whenever a capital asset is converted into stock in trade, it is regarded as a transfer. Now, one doubt can start tinkering. That is, sir, imagine I've got one asset, capital asset, one land, and I converted that into stock, into parts, and I'm doing development activity, and I'm selling that plots. And you are saying, the moment we convert, it becomes a transfer, please pay the tax. But let me tell you, law also understands that whenever you convert, money is actually not coming to that person. Consideration will actually come when such stock in trade is actually sold. For that reason, what they have specified, whenever a capital asset is converted into stock in trade, it is regarded as transfer, but please pay tax only when such stock in trade is sold. Pay tax whenever a conversion is being done, please pay tax only when such stock in trade is actually sold. So when a capital asset is converted into stock in trade, it is regarded as transfer, but the tax liability will trigger only when such stock in trade is actually sold. Next point. Maturity or redemption of a zero coupon bond. Bond is matured or redeemed, that time also whatever difference comes, that is also taxable. Next point. Any transaction in part performance of a contract of immovable property. under section 53A of Transfer of Property Act. Now, what is this? This is a very interesting section given by Transfer of Property Act, which clearly says that agreement is done, possession is handed over, buyer is ready, seller is ready, sab khatam. Only thing pending is a procedural formality. Only thing pending is a procedural formality, getting the registration done in a registration office. But rest all is done. Agreement is done, possession is done, transfer is done, everything is done, but a procedural formality is pending. Then law specified that it is still deemed to be sold. That is, it is regarded as a transfer whenever there is a transaction in part performance of contract of an immovable property as per Transfer of Property Act. Very, very interesting concept. This is very common where we have seen very practically a lot of circumstances where people have been selling the properties where all the activity is being done except stamping in the registration office. Still, it is deemed to be sold. Next point. Any transaction of becoming a member of a society or a company having house building scheme for its members. It is something like a housing cooperative society where a person has become member of a housing cooperative society, and since he became a member of the society, he is allotted one house. That is also regarded as a transfer. So these are the various interesting cases which are regarded as transfer. And it is important to understand this because one of the primary important condition in the chargeability section is there should be a transfer. So first point, there should be a capital asset. Second point, that capital asset must have been transferred. And what is transferred? These are all the cases which are given in the section which talks about when it is regarded as a transfer. Now see, the not regarded as transfer means in case of following the provisions of capital gains, and they are very logical points also. Point number one, transfer of asset in a scheme of amalgamation. Two entities got amalgamated. Law is telling no need subject to fulfillment of conditions. Conversion of debentures or bonds into share. Whenever debentures are converted into share, something like convertible debentures, that is also not regarded as a transfer. Then, transfer of an asset by a parent company to the own subsidiary company. Then, transfer of asset under gift or will. Very, 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 very most practical point. Let's take an example. There is a father who gifted a property to his son. Law is telling there is no need to pay capital gains tax on this gift. You might start saying, sir, capital gains tax might not attract, but income from other sources will come into picture. But income from other sources, gift concept, what we have under 56(2)(10), there also gift taxable arise if gift is received from a relative, and the relative cover any lineal ascendants or descendants. Get a gift from his father, then that is not taxable under income tax. Capital gains also will not come into picture, and also other sources will not come into picture. But tomorrow, when the son is selling that property, definitely son will be required to pay capital gains tax. Now, where I'm saying there is no capital gain is only for the gift transaction. Transfer of capital or by way of will. So in this case, there is no question of capital gains tax. Next point. Transfer of capital asset at the time of partition of HUF. There is a Hindu undivided family, and in which there are members of HUF. And these members got separated, HUF got partitioned, and members have taken away their respective share of properties. This partition of HUF is not regarded as transfer. So capital gains tax will not trigger. HUF is a very, very wonderful tax planning, what a lot of people keep doing. In fact, like how we have got slab rates, basic exemption limit of 2,50,000 for individual who is not a senior citizen 3 lakhs, super senior 5 lakhs. HUF, Hindu undivided family, has got a separate basic exemption limit of 2.5 lakh, 3 lakhs or 5 lakhs. Tax will not come for HUF because there is no question of age concept for HUF. So HUF always 2,50,000 is the basic exemption limit. It's a very, very common tax planning what a lot of people do in HUF, Hindu undivided family. Next point. Conversion of partnership firm into LLP. Next one, conversion of company to LLP. And we know the reason why lot of firms are converting into LLP. The reason being very clear that in case of partnership firm, the liability of the partners is joint and several. But when we talk about LLP, the liability is limited only to the extent of the partner's capital. That is the reason why a lot of people prefer converting the partnership firm into LLP. And that's very common. In fact, even in our CA firms, we have seen a lot of CA firms acting as LLP also. And last point, conversion of company to LLP. Why do you think a lot of companies convert to LLP? There's only one reason for that. That is because of dividend tax. Whenever company gets profit, company is paying income tax on the profit. And when the profit is declared as dividend, again that dividend is taxable in the hands of shareholder. Once upon a time, company used to pay dividend distribution tax and dividend was exempt for shareholder. But amendment has been done a few years back where they have specified that whenever a company gives dividend, the company is not taxable, but shareholder is taxable on that dividend. That is the reason why a lot of companies are trying to convert into LLP. But to take this benefit, saying that when I convert a company to LLP, I will not pay. There are some respective conditions which have to be satisfied, especially in terms of assets being transferred, liability being transferred, all shareholders becoming partners, continuing for a period of 5 years. A lot of conditions are there with respect to turnover, assets, all the conditions to be satisfied in order to take the advantage of this exemption in terms of saying that we will not pay the tax from conversion from firm to LLP or company to LLP. Yeah. So we have discussed what are the cases where it is regarded as transfer, and we have discussed where it is not regarded as transfer. And every case where it is not regarded as transfer is always followed by some conditions. Of course, law specifies condition, only then they give an exemption. Correct, right? Exactly. Now, let me move forward. What are the types of capital gains? Short-term, long-term, pretty basic, simple point. Two types of capital gains, long-term and short-term. And any gain what we get from short-term capital asset is short-term capital gain. Any gain what we get from long-term capital asset is long-term capital gain. As simple as that. This is the computation, which I'm sure most of you would have seen this, most of you would have understood this, and most of you would have used this in the practical world also. But let me reiterate once again so that we are clear on what we have learned. That is, first we'll start with full value of consideration. Whenever I talk about this word, full value of consideration, imagine we sold an asset for 1 crore, but we received only 30 lakhs. And the balance 70 lakhs is yet to be received, maybe down the lane after 1 year or after 2 years. Now, whatever case it is, we are not going to pay tax on 30 lakhs, but we are going to pay tax on 1 crore. We are not going to pay tax on 30 lakhs, but we are going to pay tax on 1 crore because we are talking about full value of consideration. Correct? Exactly. Next, from that full value of consideration, we are going to reduce expenses on transfer. But here I will add one interesting word. Expense on transfer other than STT, which stands for Securities Transaction Tax. Whenever there is a buying and selling of shares or securities on the stock exchange, we end up paying STT generally about 0.1%, some cases 0.025%, depends upon type of instrument. STT keeps changing. That STT, what we pay, we cannot reduce our expenses. Correct? So what is the starting point? Full value of consideration. We will reduce expenses on transfer other than STT. Then balance what we get is net consideration. From that we reduce cost of acquisition, cost of improvement. What is improvement cost? Something like a capital improvements. For example, in case of a building which has got 2 floors, on that 2-storied building, we are constructing one more additional floor. That is something like cost of improvement. That can also be reduced. So from full value of consideration, we reduce expenses on transfer other than STT. Balance what we get is called net consideration. From that we reduce cost of acquisition, cost of improvement. Balance what we get is short-term capital gain. Less exemption, if any. There is one strong reason why I wrote the word if any. The reason because there are very few exemptions which are available for short-term capital gains, unlike long-term capital gains. For long-term capital gains, there are huge level of exemptions what we have got. But for short-term, there are hardly any exemptions what we have. And in short-term, the directly figures what we take is cost of acquisition, cost of improvement. And there is no benefit of indexation. And what is indexation? Indexation is nothing but we are trying to escalate the actual cost based on the time value of money. But for that purpose, income tax department themselves has given index numbers on what basis we are going to do the indexation, so that we'll calculate index cost of acquisition. And that indexation benefit is only and only for long-term capital asset, but not for short-term capital asset. Long-term capital asset, we only take cost of acquisition and cost of improvement. Moving forward, long-term, everything remains same except for a special word called indexation. Indexation. Now, what is this word? Index cost of acquisition. This index cost of acquisition is nothing but cost of acquisition into CII in the year of transfer divided by CII in the year of acquisition. And let me tell you, once upon a time till last year, we were actually trying to calculate index cost of acquisition on our own, and that index cost we used to enter in the ITR. But since last year, some interesting concept has been done where they have developed that utility where you just enter the year of purchase. You just enter the date of purchase, year of purchase, then automatically it is calculating the index cost of acquisition. But as such, as a student, you should be required to know what is the latest index number applicable for the current year. That's important. You need not remember all the index numbers as such. And this indexation numbers started from the year 2001, 2002. Once upon a time, it was 1981, but they shifted that to 2001, 2002. And if any asset is purchased, and let me tell you, for 2001, 2002, the index number is 100. And if any asset is purchased before 1/4/2001, very, 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 very common, because a lot of people, they might sell their ancestral property, which has been purchased before 1/4/2001. Then in that case, my dear friends, we are supposed to take original cost. We are supposed to take what? Original cost or fair market value as on 1/4/2001, whichever is higher as the cost. In fact, yesterday itself, for one of our clients, he was selling a property which he has acquired almost about 22 years back. And that property, my dear friends, he was actually selling. He purchased that way back in 1995 or so. So I told him one point, please go to the registration office, that is sub-register office, and get a certificate of what is the market value as on 1/4/2001. I will take that figure or your actual purchase price, whichever is higher as the cost. Next. Full value of consideration is the amount of consideration received or receivable for our without making any deduction therefrom, where we take the full value of consideration. But of course, we reduce the expenses on transfer. There could be some like any brokerage or any commission that we will reduce. But the starting point is always full value of consideration, where we take into account the consideration. Next point. Capital gains are chargeable to tax in the year of transfer, even if no consideration has been received. Something like we sold in the year 1920, transaction is done in 1920, but consideration has actually come in 21-22. But still you have to pay tax in 1920 only, because law is not concerned about when you have received. Law is only concerned about when the transfer has taken place. And capital gain is chargeable to tax in the year of transfer. Clear? Next point. If the consideration is not ascertainable or cannot be determined, then as per section 50D, an important section, fair market value will be regarded as full value of consideration. You cannot dare to say, I'm not able to figure out what is my actual consideration, because we have got some other non-monetary consideration, some kind of exchange of activities being done, whatever it is. If you want to say all those things, then law clearly specified that if the consideration is not ascertainable or cannot be determined, then the fair market value will be deemed to be full value of consideration. Next, expense on transfer for sale of assets, but expense on transfer does not include STT, which I already told you that we can't reduce securities transaction tax. That cannot be reduced. Expense on transfer is allowed as deduction, but does not include expenses on acquisition because it is added to the cost. We are talking about expenses on transfer, that is expenses related to sale of that capital asset, but not purchase of that capital asset. Because whatever expense is related to purchase of the capital asset is added to your cost, but not to the expenses on transfer. Expense on transfer covers only your sale related expenses. And very classical point is brokerage or commission. Next, cost of acquisition is the value which assessee has paid or the amount which he has incurred for acquisition of the asset. And it includes amount for completing or acquiring title, nothing but interest on borrowed capital. So whatever cost he has incurred for acquisition of the capital asset, entire amount will form part of the cost of capital assets. Clear? So what is the starting point? Full value of consideration. Reduce what? Expense on transfer other than STT. Then balance what we get is net sale consideration. From that we reduce cost of acquisition, cost of improvement. And by any chance, if it is long-term capital asset, we reduce index cost of acquisition, index cost of improvement. And the balance, what we get is short-term or long-term capital gain. And from that, we take exemptions. And of course, any exemption we take is always subject to some conditions, which we'll discuss. All the exemptions we'll talk, don't worry. Next, cost of acquisition. Friends, let me give a small example. Let's not trouble ourselves. So imagine, Shivateja got a property as gift from my father. And tomorrow, when I'm selling that property, what will be the sale price? Full of consideration. From that, what will I reduce? Expenses on transfer. Balance what I got? Net sale consideration. From that, what I'm supposed to reduce? Cost of acquisition or index cost of acquisition. Now, please tell me, what is the cost of acquisition for Shivateja? Cost of acquisition for Shivateja is 0. Reason because Shivateja did not pay any price. It came as a gift from my father. But law says, you please take cost to the previous owner. Cost to the previous owner. So sweet of them, where they have specified that if the property has come as a gift or by inheritance or by partition or by distribution or any way of transfer to an asset, transfer to a trust, in all these cases, we will see cost to the previous owner. Next point, asset acquired before 1/4/2001. Already we discussed what will happen. We will take actual cost or fair market value 1/4/2001, whichever is higher, that is taken into account. Shares, original shares, amount paid for acquiring these shares. Right shares, amount paid by him for right shares subscribed by other person. I told you that if Shivateja has got some right shares, if Shivateja has got some shares and I have been given a right to purchase a right share, that right I can transfer to another person, technically called as renunciation of right. In that case, that particular person who has taken right from me, he will pay the amount to the company for purchasing the share, and he will also pay some amount to me because he has taken right from me. So what will be his cost? Purchase price paid to the person renouncing such right plus amount paid to the company allotting such share. This total the cost of acquisition. Next slide. Bonus shares allotted before 1/4/2001. Obviously, we'll take original cost or fair market value, whichever is. Original cost is 0. So I'm going to take fair market value as on 1/4/2001. And if bonus shares allotted on or after 1/4/2001, my cost will be nil. Obviously, because bonus shares, there is no price that is being paid. It has come clearly, purely free of cost. Sweaty equity shares, fair market value considered for calculation of perquisites. If there is an employee, he has given ESOP to the employee stock option plan, sweaty equity shares. Then for employee, it becomes a perquisite, which we would have paid tax under. Correct? Perquisite value will become the for subsequent sale. So in case of subsequent sale by the employee, whatever value employee paid tax, that value will become the cost for the employee. Next point. 112A, very, very important. We'll talk in detail separately, my dear friends. In detail, we'll talk. That point is about long-term capital on sale of equity shares or units of equity-oriented mutual fund through recognized stock exchange on which STT is paid. We will pay tax at the rate of 10% on amount exceeding 1 lakh. But there is one very special point what is to be noted. That is, in general, for every asset, we discuss a concept that if an asset is acquired before 1/4/2001, if asset is acquired before 1/4/2001, we will take original cost or fair market value 1/4/2001, whichever is higher. But with respect to this long-term capital gain on sale of equity shares or units of equity-oriented mutual fund through recognized stock exchange on which STT is paid, once upon a time this was exempt under section 10 subsection 38. Under section 1038 this was exempt. Subsequently they made amendment in the law in the year 2018 where they told this is taxable. With effect from 1/4/2018, this is taxable. But don't pay tax on the full amount. Please pay tax only on capital gain exceeding 1 lakh. So if you get a capital gain of 1,20,000, please pay tax at the rate of 10% only on 20,000. And how do we calculate the cost? This working is very interesting. Okay, let's see that now. What is the cost? How do we calculate the cost? Is higher of actual cost or lower of actual sale consideration or fair market value as on 31st January 2018. Significance of that date is because that amendment came at that point of time only. So what they are trying to say, imagine guys, sale price is 100, cost price is 40. Sale price 100 lakhs, cost price 40 lakhs. Okay guys, yeah, and FMV and 31st Jan 18 is 50 lakhs. Okay, now what law is trying to say, first you calculate lower of sale consideration or market value, whichever is lower, that is 100 or 50, whichever is lower, which is nothing but 50 lakhs. Then what is the cost of acquisition you are supposed to take is 40 lakhs or 50 lakhs, whichever is higher, which is nothing but 50 lakhs. This is working here also. In ITR, there is one separate schedule for section 112A, where we need to report each capital asset separately in the ITR. So I'll show you specifically there very clearly how do we give a treatment for long-term capital asset on sale of equity shares or units of equity-oriented mutual fund through recognized stock exchange on which STT is paid. I'll show you specifically there. Don't worry. Next, cost of improvement. What a cost of improvement? It means expenditure incurred to increase the productive quality of the asset. It includes all expenditure of capital nature incurred in making any addition or alteration to the capital assets. And only capital expenditure is considered as cost of improvement. Obviously, revenue expenditure is not considered as cost of improvement. And routine expenses on repairs and maintenance do not form part of cost of improvement. This point is very important. What is that? Any improvement expenditure, what is that word? Any improvement expenditure incurred before 1/4/2001 is to be ignored while calculating capital gains. The specific reason for that is income tax has put up 1/4/2001 has cutoff date. When I say cutoff date, I'm trying to say that if an asset is acquired for 2001, what is that line I just said? If an asset is acquired before 1/4/2001, we are going to take original cost or fair market value as on 1/4/2001, whichever is higher. Correct? That is the reason why they specified that if any improvement is being done, before 1/4/2001, that improvement is completely ignored. And that improvement could be done either by the assessee or by the previous owner. whoever has done that improvement, still that improvement cost is incurred if that cost is incurred before 1/4/2001. I hope all these points make sense to all of us. Right, fair enough. And any doubts you get, feel free to. I'll be more than happy to take up all your queries. And after some time, once we are done with our discussion, I'll take up all your queries and answer all your questions in our Q&A session. So don't hesitate. Any doubts you have, feel free to go ahead and ask. Thank you. Next, indexation, I discuss that with you. That is cost of acquisition into CII. Cost of acquisition into CII in the year of transfer divided by what, my dear friends? CII in the year of acquisition. But one point what they told in the law is that CII in the year in which asset was acquired of 2021 or 21-22, whichever. And for improvement, we will see CII in the year of improvement. One special point is here. Imagine father acquired the property in 2006-07 and 9-10 he gave gift to son. 2009-10 he gave gift to son. Now, son sold the asset in 21-22. If these are the facts of the case, my dear friends, when I talk about calculating the index cost of acquisition, what will I do? Cost of acquisition into CII for the year 21-22 divided by CII of which year should I take? Strictly speaking, as per income tax law, I am supposed to take CII for the year 9-10. That is when the actual seller acquired the asset. Who's the actual? Nothing but son. So when son acquired the asset, that is in 2009-10, that is the year what I'll take into account. But there is an interesting case law of Bombay High Court in the case of Manjula J. Shah. Very, very, very popular ruling where that indexation can be claimed from the year in which. So we can take indexation from 2006-07. And let me tell you, you might get one doubt. So what will happen if I take 6-7? What? If I take 6-7, the denominator value will come down. If the denominator value comes down, the cost will go up. Cost goes up, gain comes down. Gain comes down, tax comes down. So that is the reason why this case law is very, 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 very popular case law, which is very widely used. Then, provisions of indexation will apply in the case of long-term capital gain on transfer of long-term capital asset, except bonds and debentures other than capital index bonds. So for capital index bonds, we can take indexation, but other than that, for any other bonds or debentures, we cannot take indexation benefit, even though they are long-term. And what is this cost inflation? As I told you already, my dear friends, for 2001-2002, it is 100. But for 2017, so for the ITRs, what we are filing now, we are using 317. And for 2023, the current year, which is running year right now, it is 333 cost inflation index numbers. Next point. Rates of tax for capital gain. Very, very, very interesting. Yeah. Now let me give a simple scenario so that you get much more simple clarity on this. Rates of tax for capital gain. When I talk about tax for capital gain, we divide them into two categories. Of course, number one, long term, number two, short term. And for long term, let me tell you, tax rate is 20% under section 112. But if there is a long term capital gain on sale of equity shares or units of equity-oriented mutual fund to recognize stock exchange on which STT is paid. 10% on amount exceeding 1 lakh. It is given by section 112A. And in short term, same case, we will tax at the rate of 15% under section 111A. So this is 112A. So for short-term capital gain, it is 111A, long-term capital gains 112. And let me tell you, for any other short-term capital gains, we will tax at normal rates. So if it is individual, we will tax at slab rates. If it is company, whatever rate is applicable to them, partnership firm, whatever rate is applicable to them. That is the reason why I told for any other short-term capital gains, we will tax at normal. I hope this is pretty simple, easy, understandable. Come on. Going back to our session, as I told, 111A, what's the tax rate? 15%. Correct? Exactly. One second. Yeah. So under section 111A, the tax rate is what? 15% when there is a short-term capital gain on sale of equity shares or units of equity-oriented mutual fund or business trust to recognize stock exchange on which STD is paid. We will tax at the rate of 15%. Next. But the important point to be noted is that the 15% tax, what we are saying. So for example, one person, Mr. X, has got capital gain, okay, of let's say 4 lakh rupees, on which he has to pay tax at the rate 15%, but he has no other income except this income. Except this income, he does not have any other income. Then law is saying do 1%. And this kind of benefit is only for resident individual or HUF. Similar kind of benefit is given under section 112 also. That is for general long-term capital gain. Clear? Then deductions. There is no question of claiming any deduction from 111A capital gain, 112 capital gains. There is no question of claiming any kind of Chapter 6A deductions. That's not possible at all. So whenever in ITR, if you are seeing some deductions under ATC and all, please ensure that you are not taking that against any capital gain. You are taking that only against salary income, other source income, business income, or any other income, but not under capital gains. Because from this capital gain under 112 or 111A or any kind of specific kind of capital gains where there are specific rates, we cannot take any Chapter 6A deductions. This point has to be very, very clear when we are filing an ITR. Next, 112, as I just said, 20%, and deductions are not provided. Next, this one 112A is 10%. That too only if the amount is exceeding 1 lakh. That point is very clear. As I told, I gave an example. If the capital gain is 1,20,000, we will pay tax only on 20,000, and no indexation benefit is allowed. There is no question of claiming indexation benefit in 112A. Come on, guys, you are just paying 10% tax, and how can you demand indexation also? But when you're talking about 20% case, there is indexation benefit. Next. Cases of capital gain, which we'll discuss now. So whatever we discuss now is what we find, which is very regular, routine, and common. Now let's talk about some special cases which we may encounter during our course of our practical training. Highly possible. Suddenly some special case will come where your principal will call you and tell, my dear article student, just get this work done. Calculate capital gain on this. And you start wondering, how do I calculate capital gain? What should not be done? All specific doubts will start coming into the brain. So let's see some interesting special case of capital gain. Number one, insurance compensation. Yes, this case I have seen multiple times where imagine there is a person who has got a building, but due to any kind of acts of God, such as flood, typhoon, hurricane, cyclone, or any accidental fire explosion, that building got destroyed, for which insurance company has given insurance compensation. Law specified that that insurance compensation is also taxable. I mean, that insurance compensation will become full value of consideration. need not pay tax on that full value. Anyways, from that full value, we'll reduce the cost and we'll pay tax only on our gain. That point is pretty clear always. It's a standardized point that we are never going to pay tax on the entire sale consideration. We are going to reduce the cost and pay the tax only on the capital gain. This section is applicable where capital asset is destroyed due to fire, flood, earthquake, tsunami, riot, civil disturbance, action of an enemy, and any insurance compensation is received. For non-depreciable asset, capital gain is same as normal case. For depreciable asset, what will you do? Take full value of consideration, but from that you will reduce WDV, because in income tax we have got a special kind of mechanism in PGBP, which I'm sure you would have heard, that we don't charge depreciation asset by asset. Instead, we charge depreciation following the concept of block of asset. And that too same rate and same type. We bring under one category and calculate depreciation based on WDV method. And for different asset, we have got different rate, highest rate being 40%. Then, where any asset is destroyed and insurance compensation is received, and no compensation received. See that line? Where any asset is destroyed and no compensation received, it shall become a dead loss, because 45(1) does not get attracted. When will 45(1)(a) come into picture? Is only in case where a capital asset is destroyed for whatever reason it is, what we discussed in terms of fire, flood, tsunami, civil disturbance, fire explosion, action taken by enemy in all these cases, and moreover, insurance compensation is received. Then only this 45(1)(a) will come into picture. If no insurance compensation is received, 45(1)(a) will not attract. And 45(2), very important. Already I told you this point, my dear friends, that is about conversion of capital asset into stock in trade. Whenever an asset is converted into stock in trade, income from, what is that line? Income from capital gains as well as profits from business will arise. Why? Listen. One person, Mr. A, he had some land and building, which was a capital asset, which he converted into stock in trade. What law said is that whenever this kind of conversion happens, whatever is the fair market value of the asset as on the date of conversion, fair market value of the asset as on the date of conversion shall be regarded as a full value of consideration. And please pay the tax only when the asset is actually sold. Now, when the asset is actually sold, the difference between actual sale price and the fair market value considered for capital gain will become business income. Assume fair market value is 10 lakhs. Now, using this 10 lakh figure, you will start calculating capital gains. Correct or not? Yes. But subsequently, this is sold for 12 lakhs. Then 2 lakhs will be taxed under business income, and it is mere common sense that is taxed as business income because this asset has become a stock in trade. And whenever we talk about a stock in trade, definitely business income only will come into the picture. Clear? So, income from capital gains as well as profits from business will arise when the capital asset is converted into stock in trade. And indexation is only available up to the year of conversion, because that is the year which is regarded as transfer. Since that is the year which is regarded as transfer, you can take indexation only up to that year. And if only part of the capital asset is sold, then only proportionate of gain is taxable, because as we clearly read, heard, understood just now, that is, whenever there is a conversion of capital asset into stock in trade, that is regarded as transfer, but please pay tax only when the stock in trade is actually sold. So it is important point to be noted that even though capital gains has triggered, when that conversion has been done, payment of tax is to be done only when the stock is sold. So sale of that stock only will invite payment of tax from pocket. Even though the year of conversion is only the transfer, tax payment will come into picture only when such stock in trade is actually sold. Next point. Fair market value on the date of conversion is regarded as full value of consideration. That's what we just discussed. Then, ULIP, unit linked insurance plan. Already we discussed this, my dear friends. In case of unit linked insurance plan, I clearly told you that on or after 1/4/2001, where any person receives at any time during the previous year any amount under ULIP on or after 1/4/2001 to which exemption does not apply under section 10(10)(d). When exemption will not apply, premium payable is exceeding 2,50,000 for any of the previous year during the term of such policy, or aggregate of premium exceeding 2,50,000 in any of the previous year during the term of any ULIP or ULIPs, in such case where the premium payable by a person for more than one ULIP issued on or after 1/2/2021. Then any profit arising from receipt of such amount by such person shall be chargeable to tax under the head capital gains and shall be deemed to be income of the previous year in which amount was received. So whatever profit he gets from that ULIP, that will become taxable. And that too only it's taxable only when premium payable is more than 2,50,000 for any of the previous year during the term of the policy. Then only the maturity amount or withdrawal amount what we get from ULIP, that becomes taxable. Next line, 45(5), compulsory acquisition, where any land or building is being taken over due to some development of the government or any infra project or any metro project, whatever reason it is. Whenever there is a takeover like that or compulsory acquisition like that, 45(5) will come into picture. And law says that is also taxable. But you do not pay tax on the entire sale consideration or compensation what you got. You will pay tax only on the capital gain what you got. But there is a possibility where I've seen a lot of cases like this, where due to expansion of roads, one land was taken over by the government and government has given compensation of 50 lakhs and the person was not happy. He filed a suit in the court of law for enhanced compensation and the 50 lakhs got enhanced to 70 lakhs. Now this gentleman will get extra compensation of 20 lakhs and law is telling that extra compensation of 20 lakhs, which is an enhanced compensation, that is also taxable. See now. Full value of consideration, expenses on transfer, cost of acquisition index, cost of acquisition, cost of improvement, balances capital gain or loss. Consideration received against compulsory acquisition by the central government shall also attract capital gains. Enhanced and further enhanced compensation will also be considered for the purpose of capital gains. Finally, cost of acquisition, cost of improvement shall be taken as nil while calculating capital gain, compensation or further compensation. That's very clear. Next, 45(5)(a). This is a very simple point. And of course, once upon a time, this was very, very, very critical. Now became more simple and easy. Sir, imagine there is a landlord who has got a piece of land. Okay. And this landlord executed an agreement with developer. 6 flats are taken by developer. Example, 4 flats are taken by landlord. Don't think, sir, for where from you got the 60-40 ratio. There is no standardized point that 60-40 is the standard ratio as such. It could be 50-50 also, whatever ratio it is. It depends upon whatever is agreed. But what I'm trying to say is that there is some part of the development which is enjoyed by the developer because developer has incurred development cost. And there is some part which is enjoyed by the landlord because landlord has given that piece of land. This is technically known as a joint development agreement. Now see, assessee being an individual and HUF who enters into a specific agreement for a development of a project, then in the year of certificate of completion, in the year of what? Certificate of completion of the whole or part of the project is issued by the competent authority shall be chargeable to tax. So when the certificate of completion is received, that year only capital gains will trigger. But what is the value we'll consider for calculating capital gain? Law specified that please take stamp duty value of his share. Example, 4 flats, stamp duty value of his of issue of completion certificate plus consideration if any received in cash. That is taken as full value of consideration. Rest of the story remains same. But there is one box here which is very special, which has to be borne in mind always. That in case assessee transfers his share. Assessee transfers what, my dear friends? His share in the project on or of issue of said certificate. That means on or before date of issue of completion certificate. Then capital gains will be charged in which transfer took place. That is when agreement is being done. And normal provisions of capital gains shall apply. So it is very, 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 very important that to enjoy this benefit of exemption for paying tax when certificate of completion is received, the important concept in the law where they have specified that this particular landlord, that is individual or HUL, who has given his land for development, he should not transfer his share in the project on or before the date of issuance of completion certificate. Very, very important point. And of course, very practical, because since last few years, we have been specifically seeing that lot of landlords are giving their land for developments because landlord is not having enough money to develop the project and developer is not having piece of land with him to develop project. So he will come together with the landlord and say, boss, I'll develop the project. Whatever is coming in the project, we both will share. I will take some share because I have put the money to develop. You take some share because land belongs to you. Technically called as joint development agreements. Next. 50C, of course, very, very important section. Guys, I'm sure you would have definitely come across this somewhere or the other. If you have not seen, let me tell you a very, very interesting point in this. So, for every land and building, there is a government approved value known as a stamp duty value. I repeat again, for every land and building, there is something called as government approved value, technically known as stamp duty value. Imagine if selling price is 1 crore and the stamp duty value is 1.3 crores. Law is telling, my dear friend, you sold the property at less than government approved value, but still please pay tax on 1.3 crores only. That means if selling price is less than stamp duty value is deemed to be selling price. But one small relaxation they have given, that is 10% variation is okay. In fact, this was once upon a time 5%, but they told, amended this point and they told 10% variation is okay. That means what? If selling price is 1.1 crore and the stamp duty value is 1 crore and the stamp duty value is 1 crore 7 lakhs, still you can take 1 crore only. So if the value adopted by Stamp Valuation Authority does not exceed 110% of consideration received, then only stamp value is considered. So if it does not exceed 110%, selling price can be taken into picture. So here, let me highlight some interesting point. So this is the capital gains area in your income tax return, where whether it is short term or long term, when we talk about land or building or both, first point you can see here, full value of consideration. That means what is the actual value of consideration? Second, they're asking what is the value of property as per Stamp Valuation Authority? Nothing but stamp duty value. Now you can see some interesting line below. Full value of consideration adopted as per section 50C for the purpose of capital gains in case A2, that is what stamp duty value, does not exceed 1.10 times of A1, then take this figure as A1 or else take A2. That means if the stamp duty value does not exceed 110% of selling price, then selling price is taken into account. But if stamp duty value is more than 110% of selling price, then stamp duty value is considered. This is what is clearly given in the law and clearly given in the ITR also. So whenever we are filing ITR, we always give the stamp duty value also in the income tax return. Clear? Next. Moving forward. And if value is done by valuation officer and that is higher than stamp duty value, we'll take stamp duty value. And if valuation officer gives lower than stamp duty value, we can take valuation officer value. Because sometimes it does so happen that is a genuine case that property is being sold for lesser value, stamp duty value is more, but in market that much value is not there at all. Then the saying that, sir, please refer the valuation to a valuation officer. Let the valuation officer decide what is the value of this. And if valuation officer says higher than stamp duty value, then we take stamp duty value only. But if valuation officer says lower than stamp duty value, then the value as assessed by the valuation officer, that is taken into consideration. Interesting. Next. 115A, this is only for a non-resident, only and only for non-resident who is buying shares or debentures of Indian company. Imagine, guys, something like this. Imagine something like this where there is a non-resident, and this particular non-resident, what he has done is he purchased shares or debentures of an Indian company, and that shares or debentures what he has purchased of an Indian company, he purchased using foreign currency. Let's say he purchased in dollars, and tomorrow when he is selling in INR. Tomorrow when he's selling, what is he doing, sir? Selling in INR. Now what they told is that, for example, selling price is 10 lakhs. Expenses are 1 lakh. Net sale consideration 9 lakhs. And assume cost is 3 lakhs. Capital gain is 6 lakhs. Law is telling, first convert that into foreign currency of dollars. Using foreign currency, that is dollars, using buying rate. I mean, average of buying rate and selling rate. What is the buying rate, selling rate? Buying rate is the rate at which bank will buy. Selling rate is the rate at which bank will sell. So using that, you please convert. Imagine when you converted, you get this figure in dollars. 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 Balance figure also will get in dollars. Now this balance figure, what you have got in dollars, one second. And this balance figure, what you get in dollars, that we again convert into Indian rupees using the buying rate. So basically, what law is trying to say is that in case of a non-resident, if he is buying shares of an or debentures of an Indian company using foreign currency, then we'll convert that into, Indian currency into foreign currency. We'll convert that, what, my dear friends? Indian currency into foreign currency, and again reconvert that capital gains in foreign currency into Indian rupees. And on what basis we reconvert? See now. See what they have specified. He is a non-resident, and what he has done, he has transferred shares or debentures of an Indian company, and they were acquired in foreign currency. Correct? Now what they are saying, sale consideration, please use average rate. Cost of acquisition, average rate. But these on date of transfer, these on date of acquisition. Transfer expense on date of transfer. Now whatever capital gain you get, now please convert that capital gains into Indian rupees using the buying rate on the date of transfer. And TTBR stands for telegraphic transfer buying rate, and TTSR stands for telegraphic transfer selling rate. Using that rate, you please convert all Indian figures into foreign currency. Then you get capital gains in the foreign currency. Now reconvert that capital gains of foreign currency into Indian currency and pay the tax. Next. Some special provisions of tax in case of NRI. Now who is an NRI? NRI is somebody who is a non-resident as per income tax, but he is a citizen of India. And who is a non-resident? Already we know, my dear friends. Somebody who does not satisfy any of the basic condition. Then we call him as non-resident, but still is a citizen of India. For him, they told you can pay tax only at the rate of 10% on long-term capital gain on transfer of specified assets. And if you have got only that income, there is no other income, and TDS is being done on that income. There is no requirement to file income tax return also. This fantastic benefit is given to an NRI, non-resident individual, who is a non-resident, but he is a citizen of India. Next, see that? What is specified as a shares in Indian company, debentures given by Indian company, which is not a private company, deposits with Indian company, which is not a private company, any security of the central government or any other asset as central government may specify. And it is important to note this point that above assets must be purchased using foreign currency. And for this NRI, whenever he is selling this specified asset, on that he will pay tax on long-term capital gain at the rate of 10%. Correct, my dear friends? But for him, there is one special exemption given under section 115F. Very, very popular section, guys. What is that, please see? This is applicable only to an NRI, and he has got gain from foreign exchange asset. And within 6 months, he has invested whole or the part of net consideration in any of the specified asset or savings certificate. Exemption is allowed. And to claim the exemption, there is some formula, and the formula is same as 54F. And let me tell you, 54F specifies that the exemption what you will get will be amount invested into long-term capital gain divided by net sale consideration. So you get exemption proportionate to the net sale consideration in 54F. So 115F is similar to 54F. And there is a lock-in period of 5 years which needs to be followed. And capital gains as exempted before in the year of transfer of new asset in case where there is a default. That means we did not follow the lock-in period. Moving forward. So friends, till now we have spent a lot of our interesting time, and thanks to you guys that you have given some precious time of yours to discuss a lot of interesting aspects in terms of capital gains, short-term, long-term, how do we calculate, what is the rate of tax, and we also discuss some special interesting cases in capital gains. Now it's time to talk some very interesting area in capital gains. That's nothing but exempt capital gain. So for example, one person has sold some house and he has got long-term capital gain of 5 crores. If he has to pay tax on this 5 crores at the rate of 20% plus surcharge plus cess, it becomes too very costly for him. So law is telling, it's okay, my dear friend, I'll give you some exemption, but subject to some interesting condition. I will tell you what are the conditions. What should have been sold, what should have been purchased, what should be the time limit, all that aspects we will put up as conditions, and then we'll give you exemption. That is what law has very clearly specified. Number 1, the most popular section, section 54, sale of residential house property. And let me very clearly read that line once again. Say residential house property. If a person sells a plot of land, he cannot take 54 exemption. 54 exemption will come into picture only when the asset sold is a residential house property. Then only section 54 will come into picture. So for an assessee, being an individual or HUF, assessee who is an individual or HUF, capital gain arised term capital asset being a residential house, the income of which is chargeable under the head income from house property. Yeah, so what should have been sold, my dear friends? He should have sold a residential house, and that too the capital gain should have been a long-term capital gain. If it is short-term, then you can't take section 54 exemption. Section 54 applies only to a long-term capital gain on sale of a residential house. Assessee shall, within a period of 1 year before or 2 years after the date on which transferred to, or as within a period of 3 years after that date, constructed a residential house in India. Some interesting point I want to clarify here so that you get complete clarity of thought. So for example, one person, Mr. A, he sold a residential house. And he sold this residential house, let's say, on 10/10/21. Now, what is the story here? He has got some long-term capital gain. Then law is telling, my dear friend, Mr. A, within 1 year before, or within 2 years after, you purchase a house, then within 3 years, construct a house. Then I'll give you exemption. But one very special point to be noted here. He sold the property when, sir? 10-10-21. And X decided that he will buy another residential house in India. Okay, guys. He has got how many years time? After the date of transfer, he has got 2 years time. That means technically he has got time till 9-10-23. Correct or not? Yes. But the problem here is, for Mr. A, capital gains has come in the financial year 21-22. Correct? And for this 21-22, he has to file return of income. And the due date could be 31st July or 31st October, as the case may be. 31st July if it is not a tax audit case, 31st October if it is a tax audit case. Assume the due date for return of income is 31st July 2022. Now what A is telling is, boss, I have time till 9-10-2023. I will buy. I'll buy. Believe me, trust me, I'll buy. Now law is telling, what is the guarantee you'll buy? We don't believe you. And A is telling, you should believe me. Now, things won't work only on belief. Correct? Now, what they have specified in the law is that if on or before due date of return of income, I repeat again, if on or before due date of return of income, if the asset is purchased, very good, or constructed, very good. If reinvestment in a residential house for purchase or construction is not made before the due date of return of income, then that is deposited in capital gain deposit scheme. The person cannot loosely do whatever he wants with that money. And moreover, he can't even put that money in his own savings bank account or current account. That's not allowed. Lot of people do this crazy mistake that whatever capital gain they get, they think that, boss, I've got 2 years time with me to buy the house, 3 years time with me to construct the house. I'll put that money in my bank account and I'll relax. If you do that, let me tell you, no exemption will come into picture. Exemption will come only when the amount is deposited in capital gains deposit scheme. This is something like a lock. What law is telling, you put that money in that account, I'll give you exemption. And we'll keep a watch on you. That before 9-10-23, if you purchase, very good. And if that capital gains deposit scheme, whatever money you have put it, if you have not utilized that before 23 or for construction 9-10-24, then that unutilized amount will ask you to pay the tax. And of course, they'll also ask you to pay interest also. Because you enjoyed exemption, you escape the tax that time. Telling that I didn't buy the property, I have put the money in capital gain deposit scheme. You might get one doubt. Sir, how will income tax know whether I put in capital gain deposit scheme or not? In this ITR, let me show you very clearly. I'll go to long term because this is only for long term. See here, when I talk about long term capital gain on sale of house, and here there is some exemptions and all, 54, 54B, EC and F and all, which we are going to talk. Clear? See here one point here. I'll show you 54 exemption, that table I'll show you. You'll understand by that. See, when I reduction of 54, please see what are the columns they're asking. What is the date of transfer of asset? What is the cost of new house? What is the date of purchase or construction of new house? And what is the next box, sir? Very, very interesting line. Amount deposited in capital gains account scheme. So you cannot loosely put in your savings bank account or current account. It must be put in capital gains deposit scheme. Only then exemption is allowed. And if it is not deposited in capital gain account scheme, then there is no question of exemption. A lot of people fail to do that and fail to get exemption. So it is very important that whenever any relative asks us and tell, I sold a property, how much time I have? You happily tell, 2 saal, bindas. 2 saal bindas nahi hai, dost. It's very important that we need to invest that before due date of return of income. If you have not done it, put that money in capital gain deposit scheme. If you don't do that, no exemption, gone. And the amount of exemption available will be amount invested in new capital asset or capital gain, whichever is lower. and you would observe that exemption is allowed only for one residential house. But if the amount of capital gain does not exceed 2 crores, latest amendment, if the amount of capital gain does not exceed 2 crores, assessee can acquire up to 2 residential property. Generally, exemption will come only when you buy one residential house. But if the capital gain is not more than 2 crores, then you can get exemption even if you buy 2 houses. But this benefit is only once in lifetime, not every year. This is only for once in lifetime benefit. And there is a lock-in period of 3 years. That means whatever new property you purchase, you should not sell within a period of 3 years. If you sell, then there is no question of exemption. Next point. 54B, urban agricultural land. Assessee being an individual or HUF, capital gain has come on transfer of urban agricultural land, not rural. If it's rural, there is no question of tax at all, because rural is not a capital asset. But one important condition they put in order to claim exemption. What is the condition? Land has been used for agricultural purpose in the 2 years immediately preceding the date on which transfer took place by assessee or his parents. A lot of people, what they're doing is they have got agricultural land. The agricultural land they are selling. With whatever money they get, they are buying one more agricultural land and happily taking 54B's exemption. There were some cases which were held in Delhi, some cases in Gurgaon, where officer went to an extent where he has taken images of Google Maps and they brought an officer for doing soil testing and find out whether agricultural activity is done or not done. Because if agricultural activity is not done, there is no question of exemption. Because an important condition they put stating that the land should have been used for agriculture purpose either by assessee or any of his parents for at least 2 years prior to transfer. If not, no exemption. Very, very important. If a client comes and tells you that, sir, I sold an agricultural land, I purchased one more agricultural land, can I take exemption? You will tell yes, enjoy. But check with him also that whether that land was used for agriculture purpose or not for 2 years. Exemption is what? Amount invested in new asset, urban or rural, or the capital gain, whichever is lower. And here one beautiful, super duper point, what you should keep in mind is that this 54B is allowed for both long term and short term. Sometime back 54, what we discussed was only for long term, but 54B is for both short term and long term. Now I'll show you something which you will enjoy. So this is ITR form. Yeah. Now let me take you to short term capital gain. This is long term. Let's go to short term. See, in short term capital gain, if you look at exemptions, you will find only one section 54B. That's it. So for short term, other than 54B, there is no other exemption. At least in long term, we have got 54, 54A, 54EC and all. But in short term, only 54B is there. That is why sometimes when client come to me and tell, sir, I sold one house, you cannot directly jump into conclusion and tell, buy one more house, enjoy exemption. No. First check with him whether it is long term or short term based on period of holding, 24 months, more than 24 months, long term. Then check whether it is residential house or not. Yes, very good. Then you tell him, boss, buy one more residential house or construct another residential house within that time span, take exemption. And moreover, if you don't do that before due date of return of income, put that money in capital gain deposit scheme. Then you take exemption. Tell all these points very clearly. Don't loosely tell, sell a property, buy a property, take exemption. It's not like that. It's not at all like that. There are a lot of things involved. In fact, I don't want to quote the fees amount, but let me honestly tell you that whenever a clients come to me with only normal activity, I charge a different fee. But when a client comes to me and tell there is a capital gain transaction involved, my fees is very much different because there is a lot of activity what I have to do. There's a consultation, advisory activity where checking, verification, computation, all the activities have to be done. I'm not trying to tell you this so as to make you understand that charge more fees. I'm telling this only to make you understand that there's a lot of activity involved in computation of capital gain and claiming of exemption. Don't just try to jump into conclusions just like that. Yeah, next. Last few more sections to talk, then we'll come to our Q&A session. And the lock-in period is again 3 years. 54EC, most popular. If a capital gain has come on account of transfer of long-term capital asset, that is land or building or both, and within a period of 6 months, just 6 months, that's it. Within a period of 6 months, he should purchase long-term specified asset, nothing but some bonds, and that bonds of NHAI, RECL, Power Finance Corporation Limited, Indian Railway Finance Corporation, he can take exemption. And the exemption will be whatever he invested or capital gain, whichever is lower, subject to maximum 50 lakhs. If you observe in 54B, I never told this word 50 lakhs, but this word 50 lakhs is there only in 54EC. Somebody can ask, sir, imagine I sold a house. I got 1.5 crore capital gain. And I purchased one more house, residential only. 1 crore I got, 1 crore of asset purchased. Can I take 1 crore exemption? Yes, of course. Balance 50 lakhs, you don't want to pay tax. That 50 lakhs also, you put in this bonds and take 54EC exemption. You can combine 54 and 54EC also. Possible. Next. But here lock-in period is 5 years. That is important. These bonds should not be sold or offered as security for availing some loan. You cannot do that with these bonds. 54F, same like 54. But the difference is what I'll tell you. 2-3 interesting differences. Difference number 1, 54 will come into picture when you sell a residential house property and you purchase another residential house. But 54F will apply if any long-term capital asset other than residential house is transferred and investment is made in residential house. And time limits are same like 54, within 1 year before or 2 years after. Construction 3 years after. But for exemption, we have a formula, which I already told you. Amount invested into long-term capital gain divided by net sale consideration. And the lock-in period is 3 years. And this section will not apply if, first condition, very, very important. Assessee owns more than one residential house other than the new asset on the date of transfer of original asset. That means he should not have more than one house. That means what residential house he is buying, to claim 54F exemption should be his first house or it can be his second house, but cannot be his third house because he can have one residential house. Law told he should not have more than one, but one can be there, no? Yes, but in 54 there is nothing like that. Imagine Shivateja has got 10 houses. 10th house I sold and I purchased one more house. I can still take 54 because there they never told you should not have more than one house. That condition is there only in 54F. You might ask, where practically you use 54F, sir? There was one of my client who sold some shares and he got long-term capital gain. And using that money, what he got from shares, he has invested in a residential house. I can't apply 54, but I can definitely apply 54F. 54F will apply whenever there is a capital gain on account of transfer of long-term capital asset other than residential house. If I sell residential house, buy residential house, 54 will come. If I sell anything other than residential house, invest in residential house, 54F will come. One more condition. Section shall not apply if assessee purchases any residential house other than new asset within a period of 1 year after the date of transfer of original asset or constructs any residential house other than new asset within a period of 3 years after the date of transfer of original asset. So we basically want to give this benefit only to those who are buying their second house or first house, but cannot be their third house. Something like that. Next. Capital gain account scheme. Already I discussed a lot with you, but still let me read. Amount of capital gain which is not utilized by assessee for purchase or construction before the due date of return of income should be deposited in capital gain account scheme before the due date of furnishing return. Yeah, and the details of the deposit are required to be mentioned in income tax return. I already told you this. Finally, last point. In case assessee deposits the amount in capital gain account scheme but does not utilize the amount for purchase or construction within the specified period, amount not so utilized shall be charged as capital gain of the year in which period of 3 years is completed from the date of sale of original asset. Clear, friends? Next. Set off of loss. I don't think I have to talk much with this. We all know this point. Long-term capital loss, we will set off only with long-term capital gain. Short-term capital loss, we can set off with short-term capital gain. and long-term capital gain. And at any given point of time, if you are not able to set off that losses, you can still carry forward that loss for a period of 8 years. For a period of how many years, sir? 8 years. But long-term capital loss only with long-term capital gain. And short-term capital loss, we can set off with short-term capital gain and long-term capital gain. But always one very, very important point to be noted, my dear students, is that loss can be carried forward only if return of income is filed within the due date. That is the reason why before the due date, we start running around. Especially if it's a loss return, we cannot carry forward the loss if return is filed after the due date. House property loss, unabsorbed depreciation story is different. But this short-term capital loss, long-term capital loss cannot be carried forward if return is filed after the due date. So if you want to carry forward this loss, it is very important that return must be filed within the due date under section 139(1). So with these interesting elements, my dear friends, I would like to complete my presentation in terms of capital gains, specific provision, chargeability section, rates of tax, types of tax, and the kind of exemptions involved, and the amount of reporting to be done in the income tax return. So with this, I would like to conclude my presentation, being open to all of you guys to discuss all your queries. Any query you have got, feel free to ask. We'll be more than happy to answer. Thank you.
Thank you, sir. Thank you for such a wonderful session and expanding the knowledge of the students in such a lucid way. Now come to the questionnaire session that will be taken by our second speaker, CA Rushikesh Vandeji. He's a chairman of Satara Vikasa branch. Now, before that, there are some questions that are coming. Students were asking, how can we access the previous webinars? Previous webinars can be accessed by searching on the ICI YouTube channel. There is a PTM session. All 11 webinars are hosted over there. As well as you can log in on the DLS platform of the ICI and browse the PTM section under SSEB events. You can see all the webinars hosted over there. Sir, Rushikesh sir, session handed over to you.
Yes, thank you, Vidhi ma'am. First of all, we are really grateful to Shiva sir for wonderfully explaining all the capital gain provisions. As far as I know, from the academic point of view, as well as in the practical point of view also, capital gain is one aspect which is little bit more complicated and more tedious for understanding also, as well as for implementing in the practical life. But you had made it very simplified it, and बहुत ही अच्छी तरीके से आपने cover up किया. Not only theoretical part, but you have also explained it by integrating it with IT return, and it is very fantastic, sir. बहुत अच्छा लगा, and I am really appreciate the efforts taken by Vidhi ma'am, Alok sir, and all the entire team of Board of Studies for having such a fantastic practical based webinars. This has been really need of the hour, and I'm sure many members are also even interested and taking benefit of these sessions. So now I would like to move forward to the questions. There is one question from Subhash Mehta. Security transaction tax की treatment क्या है? उसके बारे में थोड़ा सा जानना चाहते हो. Even if it has been already covered, let's get it once again.
Yeah. So basically, the securities transaction tax, what we're talking about, STT, where the rate of tax ranges between 0.1%, 0.025% for different types of security. Let me tell you, my dear friend, that this STT, what we are paying, in fact, we don't pay also practically. वो direct होके अपने पास पैसा आता है, so automatically it's being paid. This STT, what we pay, we can't take as deduction in case of capital gains. However, let me tell you, I'm sure why this doubt would have come. In business income, in PGBP, if a person is doing activity of buying and selling of security as a business, in income tax, there is one section called section 36(1) clause 15, which talks about STT paid that you can take as deduction. But if it is a capital asset under capital gains, you can't take deduction for securities transaction tax paid.
Yes, sir. It's very fantastically answered. I hope the query has been resolved. Now I would like to move to the next question from Sumit from Jaipur. both the conditions have to be satisfied for becoming urban agricultural land?
Yes. Hi, Sumit. Very good question. See, let me tell you, both the conditions are mandatory. That is, condition number 1, it should be within that limit, and the population limit also should be satisfied. So if imagine a land is within 2 kilometers from municipality and population is less than 10,000, it becomes a rural agricultural land. And if the land is within 2 kilometers from municipality and population is more than 10,000, then only it becomes an urban agricultural land. Both conditions are mandatory. And it is very important to classify them perfectly, because once you do a misclassification of that, your entire tax treatment goes wrong. Because I have seen personally so many cases practically where some people have misinterpreted that and made rural as urban, urban as rural, and enjoy the exemption. Nahi ho sakta hai. 2 conditions are mandatory. Sir, you're on mute, sir.
Yes, sir. It was really fantastic question, and ये बहुत सारी जगह पे गलतियां होती थी. Even during our beginning phase, during articleship, we had faced a lot of confusion in this area. Thank you for covering this aspect. Next question is from Abhishek. Is it important that agricultural activity must be taking place in rural agricultural land to exempt from capital gain?
If your question is about exemption from 54B exemption condition only clearly says that it must have been used for agriculture purpose for at least 2 years prior to date of transfer. And it's very logical point that agar aapko 54B exemption claim karna hai, that logically applies only to what? Sale of urban agricultural land. If you are selling a rural agricultural land, there is no question of exemption. Whether you do agricultural activity or you don't do agricultural activity, it doesn't matter if it is a rural agricultural land. So is agricultural activity compulsory to be done for last 2 years will come into picture only when it is a urban agricultural land. So if we're talking about exemption, the answer is yes. Agricultural activity should have been done by SSE or any of his parents.
Okay, sir.
Yeah.
Next question is from Manisha ji from Delhi. What is the difference between mutual fund and SIP?
See, SIP talks about systematic investment plan. That is also see, the logic is simple. Mutual fund investment, what you are making, see, SIP is not something like a different kind of fund as such. SIP fund is nothing but systematic investment plan. Every month you are transferring some portion of your salary or income towards that mutual fund activity. Instead of investing one-time bulk amount, you are systematically investing it. That's all. There is no difference in tax treatment as such. That remains the same.
Yes. Not even in tax treatment, it is not entirely different concept also. SIP is just like one part of mutual fund.
That's it.
Investment करने का एक तरीका है बस.
बराबर.
I think I will like to ask this question to admin team. Vidhi ma'am, can we get access to the previous sessions of this webinar on practical training module?
I have just tell you this. It is available on ICI YouTube channel and ICI DLH platform. Student to log in with their user ID and the password. And under the SSAB events, these webinars are already been hosted.
Okay, ma'am. Thank you very much. There has been one query from Manoj. Hi, sir. In case of sale of equity share and mutual funds, the profit is considered at selling price minus cost or directly selling price for consideration of amount crossing 1 lakh for long-term capital gain tax.
Of course, selling price minus cost. Why do we pay tax on selling price? That 1 lakh, what we're talking about is capital gain only. Imagine selling price is 2 lakhs. Your cost is 50,000. Difference is 1,50,000. Then you will pay tax only on the 50,000. That is on the amount exceeding 1 lakh. That's it. So there's nothing called you will pay tax on selling price. That 1 lakh, what we are seeing is for the gain.
Yes. I would like to skip this question. If you have already covered, it is from Akshay. Can you please guide how to input capital gain in ITR?
See, input capital gain in ITR in terms of, in ITR, let me tell you one thing. In ITR, for long term or short term, there are 3 classifications. Classification number 1, first classification will be from sale of land or building or both. Second classification will be related to your shares or security. Third classification will be any other asset. For land and building, the core point is stamp duty value. For shares and security, core point is if it is long term, 112A will come into picture, and every asset by asset we are required to report, because we are going to pay tax on the entire capital gain only if the capital gain exceeds 1 lakh at the rate of 10%. And in capital gain for that 112A schedule, there is one first column called ISIN, which stands for International Securities Identification Number. आपको वो सब याद रखने की जरूरत नहीं. Once you type in Google for any say share, you will find ISIN. That ISIN you enter, automatically company name will come. Enter the shares what you have purchased, enter the share what you have sold, and enter the market value as on 31st Jan 2018, which your agent or any of your stockbroking company or any app or any platform what you're using to buy your security, they themselves will provide what is 31st Jan 2018 market value. Then your capital gains will come into the picture. And the 31st Jan 18 market value, they generally take the highest rate on that day. That they'll only do. You don't take your effort. Aapka statement will give all the figures. Don't worry. But for short-term capital gain, sorry sir, but for short-term capital gain, there is no need to give asset by asset for shares. You can give lump sum figure for the share. But for long-term, asset by asset is mandatory. That part you take care. Done.
Query from Ashok ji. What if supporting for cost of improvement are not available, which has been done in 14 years ago while filing the return?
This is the most practical common thing which everybody gets a doubt. I appreciate for the doubt being asked. See, generally, what happens is that client keeps coming to us and telling, sir, improvement we have done 5 lakhs, improvement we have done 3 lakhs. We take that figure. There is no supporting, there is no bill with him. But the problem here is why we are just going ahead with the figures what client is telling, because of 2 reasons. Reason number 1, while submitting income tax return, they don't ask us proof. Only when the scrutiny or any 142 any notice comes into picture, they start asking us to submit the proofs. That is one point. Point number 2, very clear. Whatever ITR we are filing is signed by the client only. We are not signing and authorizing that that figure is correct. Correct, right? So how can we vouch for that improvement cost? We don't know. If the client says we'll take it, yes, done. But हमको नहीं पता कि वो सही है या नहीं है. But I myself, let me tell you, whenever a client tell me, sir, improvement, ले लो 5 lakh, ले लो 6 lakh, I will tell my client always, sir, आप बोल रहे मैं ले लूंगा, but tomorrow notice comes, you should get me proofs. He will tell, I will take care. I will tell, okay, you take care. That's it. But as an auditor, we cannot vouch for the improvement cost unless clients submit the bills.
Yes. And actually, sir, I would like to add one more point. Being a practical article student, CA member, या फिर कुछ auditor भी हो, who is filing the return, one thing we should take care of that whatever our client is telling in orally, we should try to document it properly. उनसे writing में लेना पड़ेगा कि all these matters are responsibility जो है वो client की and not of CA. मतलब जो client बोल रहा है उसके ऊपर हम काम कर रहे हैं और उसके बिहाफ पे हम इनकम टैक्स रिटर्न भर रहे हैं ताकि हमारी रिस्पांसिबिलिटी आगे चल के नहीं आएंगे.
Correct. And better practice is to drop an email with all points what you both have understood and the computation, so that email document will be there. Tomorrow WhatsApp message if you do telling हमने कर दिया, WhatsApp गया, काम गया. Write an email, boss. Don't use WhatsApp.
Sure sir. Yeah. Format किया तो जाएगा फिर.
Exactly.
Sir, please explain shares capital gain in ITR form. Where to enter STCG and ITCG?
That I told you, right? There is a separate column for after land and building. There is a column for shares, separately for long term, separately for short term.
Okay, sir. Rahul ji, is capital gains charged to beneficial owner or registered owner of the capital asset?
See, technically, it is always tax in the hands of registered owner only. But if it is proved that beneficial owner is the actual person who is enjoying the asset, but not the registered owner, then he will end up paying the tax. But general answer is always a registered owner only. Unless specific provisions like clubbing of income come into picture, which is altogether a different story, which we'll talk about it separately. But generic answer is registered owner only.
Okay. Sir, shares purchased from option trading will come under capital gain or business income? Very fantastic question. Yes.
Sir, shares, debentures and all, when you're buying and selling, there is no specific mechanism or parameter which is given by income tax, even today, specifying that this is capital gain, this is business income. They are not categorized. They gave some cases like regularity is involved, he is doing the transaction. Aap khud mujhe batao. See, if you do 100 transaction, will you tell business income? In one day, I will sit and I'll buy 100 shares, sell 100 shares. Entire year, I will do other activity. Is it capital gain or business income? There's no specific pattern to say that regularity, number of transaction, all that cannot be the basis to tell whether capital gain or business income. Generally, what approach we follow, normally, practically, most of the chartered accountants, what we do is that we basically try to understand is a regular course of business activity and whether this capital gain with this buying and selling of shares is being carried out in the course of business or it's only a side activity what is doing. Generally, we bring it under capital gain only unless it is an F&O transaction. Let me tell you, F&O is deemed to be business. Futures and option and your intraday trading, which is speculation, that will come under business. There is no question that intraday trading F&O will come under capital gains. That will come under business only. That's clearly clarified. Income tax law specifically said that speculative transaction, which is only intraday trading, will come under business income, not under capital gain. And there have been so many cases where I dealt with a lot of my clients where they have done intraday trading on F&O transactions. We have done tax audit also for them, considering the turnover involved.
Yes, sir. Fantastic answer. And many people gets confused about what to do for option trading. But yes, it will come under business income only. Next one is compulsory acquisition of rural agri land taxable? See, rural agriculture land itself is not a capital asset. If you sell it or compulsory acquired, whatever it is, it's not taxable. Okay. In case of SIP, how period is calculated for classification as short term and long term?
Before, as per section 45(2)(a), whenever securities are held in demat form, we always follow FIFO method.
Okay. One compliment. Thank you, Jiten sir, from Nagpur. He says, nice seminar and congratulations.
Thank you. Thank you.
From query from Amul, how to report capital receipt in ITR, which is not taxable? Is compensation received from court for mental harassment is capital receipt, which is not taxable?
See, in ITR, there is one separate column for exemptions under section 10. And if it is not covered in section 10, there is a residual clause also. Any other exemption, there you can report. That column is there. Under any other exemption column, you can report that kind of exemption which is not specifically covered in section 10. If it is covered in section 10, report in that particular subsection. If it is not covered under any other exemption, you can put it. No problem.
Okay. How to match share capital gain transactions appearing in AIS with ITR? Since in AIS only sale transaction appear.
Wonderful. Very good question. I appreciate. Yeah. So nowadays, especially this year, we have been struggling a lot. Earlier, it was a simple logic that take your form 26 AS, but take the income, take TDS credit, file your ITR, matter is done. But this year onwards, we started looking at AIS, annual information statement, TIS, tax information summary. Aapko pura dikh jayega, this shares you have purchased, this shares you sold, this dividend you got. Let me tell you, what is a humble suggestion I'll give you is that tell your client to give the statement from that particular stock agent or share broker he's dealing with and match the data with your AIS and TIS. And I'm sure you might find something more in AIS TIS, but not less in AIS TIS. If it is less, go as per client statement. My suggestion, what I tell my office staff and my article student is that if you find something more in AIS TIS, take it. But if you find less in AIS TIS and more in client record, take as per client record. हमेशा ज़्यादा ही दिखाओ, कम दिखाएंगे तो problem है. That is what is relevant. So do that. Because 2 days back, let me tell you, one client I called and told, sir, you sold some shares, you didn't give me some data. He asked me reverse question. Sir, how do you know, sir? I told we have AIS, TIS. He told, wow, wonderful, you know everything better than me. And I told him, give this bank statement, this bank account number. You have not given this statement to me. He told, no, sir, I have only 2 accounts. Third account is not there, what you are telling. I told, no, sir, that account is there. In that savings bank, interest is there. He told, yes, sir. Since last 3 months, I am not operating that account, so I forgot. So nowadays, we have got a lot of data with us. we can tell the client what to do, what not to do. So get ready.
So we have to be more vigilant as well as our clients too. I have a query in my salary return. My client is medical MD student. He is paying hostel fee, but form 16 doesn't show HRA. So should I claim HRA without being shown in form 16 or deduction under section 80G?
See, it is not that you can't take HRA exemption if it is not reflecting in form 16. In form 16 part B, even if HRA is not reflecting, why it's not reflecting? That employee would have not given a declaration to the employee that I'm paying so and so rent. If the declaration is not given, doesn't mean you can't take HRA exemption. There have been umpteen number of cases and umpteen number of clients where I have taken HRA exemption, even if it is not there in form 16, provided I have taken rental receipts from the client as a documentary evidence with me. And as told by Rishikesh sir very clearly, that document it. That is very important. And if you say, no, I don't want HRA exemption, only I will take only 80 GG, take it. But 80 GG, keep in mind, 5,000 per month, maximum 60,000. That limit is there, keep in mind. HRA different limits are there under section 1030D, whatever it is. But you can still go beyond your form 16. Sir, aap mujhe ek baat bolo, that lot of times some people donate to political party or make some 80G donation, which is not there in form 16. Are you not taking while filing ITR? Yes, right? Then why can't you take HRA? Anything you can take, subject to documentary evidence. That's it.
Yes. Only one negative aspect is that there are chances of getting notices.
Yes. Highly
in limited notices.
Yes. Yes, yes, of course, sir. When 143 intimation is generated, before that they'll give a draft intimation saying that we want to raise this demand because this is not there. There is a mismatch in form 16 and ITR. So for that, you have to substantiate by reply along with documentary evidence. And they are kind enough, especially since last few years, they are considering that data and dropping the proceedings. Initially, they are dropping, not going forward to scrutiny and passing order, go for appeal. That stage is not being done. They have become kind enough.
Yes. Whether 54F can be claimed for urban agricultural land.
54F, urban agricultural land.
Yeah. Can
yes,
it be claimed?
You can do that provided urban agricultural land is sold and what you have invested is in residential house property. Then you can still take 54F. Possible. Satisfy the conditions, but.
Okay.
But you can't take 54B, 54F together. How is it possible? Because 54B will come when you invest in urban agricultural land or rural agricultural land. 54F will come when you invest in residential house. So both cannot come together. But any of them can come. Possible.
Okay. Sumit is asking related to earlier query. His question was regarding SIP of mutual fund, when it will be short term or long term, from last SIP or first SIP.
See that SIP will come under mutual fund. If it's equity oriented fund, more than 12 months is long term, less than 12 months is short term. Which debt oriented fund, we look at the concept of 36 months. But generally today's date, most of the mutual funds are equity oriented. So you have to end up seeing 12 months is done or not done. That's it.
Okay. Compliment from Manoj from Gurgaon. Thank you, sir, for a very good session training.
Thank you.
Yes, I guess most of the queries have been resolved and it was a very fantastic session. And once again, I would like to thank and we are really grateful to the whole ICI team. Being a Sunday and they are taking the time, their precious time, holiday time, and investing their time in betterment and development of the students. It has been very fantastic and बहुत अच्छा लगा है. And sir, अभी जाते-जाते एक सवाल पूछना है. Will you कुछ एडवाइस देना चाहते हो कि अभी कैपिटल गेन जैसे कॉम्प्लिकेटेड टॉपिक को हाउ स्टूडेंट शुड मैनेज ड्यूरिंग द आर्टिकल टाइम, मतलब थोड़ा और एक्स्ट्रा एफर्ट्स कैसे डाल सकते हैं ताकि दे विल बी इन अ बेटर पोजीशन टू डील विद complex situations.
Right.
Yes, sir.
Guys, 2-3 interesting points I want to tell you. Point number 1, whenever you're dealing with the capital gains for security and shares, nowadays we got a very good aid, that is your AISTS, from where you can pull the data. And whenever a person is selling a property for more than 30 lakhs, we know that registrar will file SFT, that is Statement of Financial Transaction, If it is more than 30 lakhs, buying and selling of the property, that is automatically reported in your AIS, TIS, where you can find the details. Point number 2, when we sell a property for more than 50 lakhs, buyer is doing TDS at the rate of 1%, which reflects in Form 26 AS. So specifically for capital gain, it is very, very important that you match your data from all the sources: client's bank statement, client's information, AIS, TIS, 26 AS, stock statement, purchase deed, sale deed. Take all the documents into your account, start preparing an Excel statement, do your computation with all the supporting document. And any figure you get, please write a reference there from which source data you picked up that figure, so that no element of mistake will happen from capital gain. Capital gain is one of the most complex topic, but very, very interesting area when it comes to real life and practical world. And in fact, that is the reason why I love this topic like anything. I'm so fascinated about this topic. That's the reason why when I got a call about capital gain, I was way too excited and told, yes, let's do this, because something very practical. Because there's so many issues, so many wonderful points to talk where you can enjoy and resolve all our queries. And before I conclude, my special sincere thanks to the entire team of Board of Studies and Kapilji, Vidiji, everyone have been constantly staying in touch with me, helping me right from beginning of starting of understanding that we'll do it together and till the end. Special thanks to everyone for all your kind support, and special thanks to the entire Board of Studies and all the council members who have given me this opportunity. Thanks to you. And also thanks to sir for being a wonderful co-faculty, for asking all the relevant queries and also sharing his own inputs. Thank you, sir. Thank you.
Thank you, Shivaji. Question to Vidhi ma'am. Whether this PPT will be available, and if yes, how?
Yes, sir. I'll let you know the session itself. Thanks, sir. Now we end up this session. Now I would like to thank everyone. Good afternoon, everyone. To all the one present online, our Honorable Chairman, Sir C.A. Sushil Goyal ji, respected Vice Chairman, C.A. Sridhar Mupala ji, and the keynote speaker, C.A. Sanjay Agarwal ji, and all the participants. It is such an honor for me to get the opportunity to thank you all dignitaries. On the behalf of Students' Club and Enrichment Board of Studies Operation, I extend a warm welcome to the students present online in the webinar and taking initiative of this and asking the queries. I would like to express my gratitude to our eminent speaker, C.A. Shiv Teja T and C.A. Rukesh Wande ji for their presence and contribution to make this webinar a great success. I must thank the organizing team, volunteers for working hard for every weekend to make this webinar series successful day by day. I congratulate all the participants for their active participation. Thank you everyone once again for making it a great success. Stay tuned with us on every Sunday from 10:30 a.m. to 1 p.m. on ICI TV and ICI YouTube channels for practical knowledge enhancement, organized by Students' Club Enrichment Board of Studies Operation. All data, all PPT are being hosted within 2-3 days of the webinar on DLH platform for all the students. Have a good day. Thank you.
Thank you so much.